Hi everyone, welcome to this webinar on microfinance, and we're going to talk about COVID relief and fintech opportunities, everything in between when it comes to microfinance and what it means for institutional investors to invest in this unique asset class. Today we're here together for 1 hour, and we have 3 panelists with us. And I'm going to introduce them. But before I do so, I wanted to point out the possibility to ask questions. So there is a Q&A button at the bottom of your screen in Teams, which is highly convenient. And so don't hesitate to post your questions in that function, and then I will ask them as they are relevant. If they're relevant during the conversation, I will place it there, or otherwise you'll have to wait until the end, where we have reserved some time to take questions. So without further ado, let me introduce our first panelist. Tim Kreins, let's start with you. You're a fund manager for Triodos Microfinance Fund. You have been working with Triodos Investment Management since 2016 and started at Triodos Bank in 2014. Before that, you worked in Tanzania for 2 years, setting up a vocational training project. But you started your working life as a lawyer. Now as your title indicates, you manage Triodos's microfinance fund. Can you tell us about your team and how you work with microfinance?
Yeah, thank you for having me here. Indeed, Tim Kreins, managing the Triodos Microfinance Fund. So Triodos is active in investing in microfinance since the early 90s. And today we have a team of around 40 people with 17 nationalities. So we work from the Netherlands. We did make a cost-benefit analysis. Like, does it make sense to set up branches? But we have make sure that we have people who have the roots in the region. So, for example, one of my colleagues, he is from Peru, worked with an SME bank in Lima, the capital of Peru, for 10 years, did an MBA at the Rotterdam University, and now works with us. And they bring in the cultural knowledge and the network, and it helps to have them close. So that's how we work, and that's the team I manage, and happy to tell more about what we do today.
Thank you so much, Tim. Jan Kröger, thank you for joining us today. You are Regional Director for Africa and Latin America at Blue Orchard Finance. You joined Blue Orchard in 2018 from Pro Credit Group, a development-oriented group of commercial banks, where you worked for 13 years in management of banks in Africa, Latin America, and Eastern Europe. You have a lot of experience in SME finance, having developed programs for agricultural and green finance in Mozambique and Colombia, among other things. You've also been involved in setting up a professional training institution in Africa, and you were teaching in Latin America and Germany on various finance-related topics. Now, you are director of 2 different geographies, Africa and Latin America, at Blue Orchard. Can you tell us how you work and how Blue Orchard manages microfinance investments?
Yeah, sure. And thanks again for having us today on this webinar, and hello to everyone. So yeah, in Blue Orchard, I think what really I guess makes us different is that we really work based on our local presence in the different countries, right? So we really have this very strong local offices, which in Latin America is located in Lima, which in the African case is located in Nairobi. And really our teams work from these offices in the regions. So really our Nairobi team handles all investments for our strategies in Africa, and the Lima investment officers manage the portfolios and the investments from that location. And that's really important, because for us really to be on the ground, to be able to quickly travel to a country that is nearby and engage in these relationships, I think that's been really crucial for the way we work. And the same really applies to me. So I'm of course in contact with both offices, of course, on daily level, and I'm also really engaged in traveling. So really traveling is part, or has been, and is now again, right, part of how we do our job, because again, building relationships, building trust, which is really important in the way we do carry out our business. I think that's only possible by really meeting people, and so that is why this local presence is key, and that's why also it's key for us to be able now again to engage, to be traveling, and our teams are now again, let's say, on the road, right? Going to Uganda, going to Kenya, going to West Africa. We've been now recently to Mexico, to Brazil, Panama. I mean, really where we see opportunities, where we see markets again developing post COVID, and that's really how we do our job and now try to do again. So now that sort of the world is opening up again, right?
Great, thanks, Jan. We look forward to hearing more about how you work. And our last panelist, Cecilia Kellner, you are investment manager and sustainability strategist at Nordea Life and Pension. You manage, among other portfolios, the Nordea Sustainable Family products, and you focus in particular on sustainable investments and impact investments within private equity and venture capital, for example. You joined Nordea in 2016, and before that, you worked as a credit analyst at BNP Paribas and as a senior portfolio manager in listed equities at Strand Kapitalförvaltning, as well as in equity research analyst, as an equity research analyst at Carnegie Investment Bank. Now, can you tell us how you view microfinance as an investment opportunity for your pension investments? What kind of exposure have you decided to take, and what is the investment rationale behind it?
Well, I mean, we really like microfinance too. It has a quite broad angle of the investment. We have placed it in fixed income, where it belongs to our emerging market exposure. That's where we have placed microfinance. Pension investment managers likes to look at buckets, so we want to place all our investments in a squared bucket. That makes us feel comfortable, but it's an investment that we like because it's very uncorrelated to all the other investments that we make, which is good because it's a long-term commitment that we have towards our customers, and we want to make sure that we look at both risk and return angles and diversification. And at the same time, apart from the financial perspective of this investment, which needs to be something that we offer because we need to have a financial return, but it also gives another dimension to the savings and to our customers, given that it's supporting entrepreneurship for small entrepreneurs and people that are not so financially well off, I would say. So to that extent, it's a nice story combined with the fact that it's also a diversified investment. So that's why we like it.
So about this diversification effect, indeed, historically, microfinance has shown decorrelated returns with most asset classes. But I think everyone was wondering how it was going to pan out during the COVID crisis, because COVID has really affected every community around the world, eventually in some way. And so how have you lived the COVID crisis from a microfinance investment perspective? Were you worried, and what happened for the investments you made?
Yes, I would lie if I say we weren't worried, because when COVID hit, of course, we saw that all these areas where microfinance very active was completely locked down. You have the virus was spread, you have lack of vaccine, etc. So it's an area we were worried about all our investments, and microfinance was not an exception. And of course, return was hit with microfinance, but we still did see some comfort in the fact that we did not see that many liquidity problems within microfinance. We did not see that many losses as we might have worried about initially. So I think that it was actually doing better than what we had expected. It was also the diversification worked. It was doing, our investments were doing a little bit better than in other areas, for example. It was not a good year, I wouldn't say. 2020 was not a good year for those investments, but I would say that it was much better and it was handled in a very good way. It seems like when we had discussions with our managers, it seems like they were very supportive of their customers, offering more flexible payment structures, just to sort of avoid liquidity problems, avoid more bankruptcies in some of the larger institutions. So, and also we did see some added customer base in during the COVID crisis, that people that needed capital that came from other parts as well, that now microfinance was an option for them when the others were basically closed. So better than we worried about, I would say.
Yeah, so that's a good point. Tim, maybe you want to pick up on that. There was a bit of an initiative that Triodos launched there, and that a lot of other managers followed to answer the needs of the communities where microfinance is very important.
Yeah, I think indeed, as Cecilia pointed out, liquidity was very important to look at in the sector, but also with the investments that we have. So looking back a little bit, so when the COVID crisis started, so it was March 2020, we also had to indeed look what was happening on the ground. Here it's important maybe to explain the background of the decorrelation in that sense. So indeed, it's true that there's this asset class, there's a decorrelation to many market driven asset classes. And this is, for example, something that we see in 2008 with the great financial crisis, which was not so much a crisis in the real economies in emerging markets. So in that time, you see that most microfinance investment funds, there was almost no impact actually of the crisis on their returns. What happened now was in that sense different, that this was a crisis that also hit the real economy, and a major driving being A, the virus, but B, also the restrictions imposed by governments. I think in many emerging markets, the impact of the virus was dramatic. So in terms of healthcare, infrastructure was inadequate, if you look at the restrictions, the full lockdowns had also their impact. So for a lot of people, it meant businesses were closed, could not travel, and for many people, a couple of days or weeks without income means no food for the family. So that's really, we had to look really close on what was happening on the ground. So we gathered information, and I think every micro finance investor did it by themselves, but map quickly like where are the risks, increase contact with all the investments that we have, the investees, what is happening there. And what you could see is that, well, the businesses, they had to close, so they had no income. A lot of times, if they had, for example, staff, well, cost continued. The same for the financial institutions, the microfinance institutions. So they had no income because there were no interest payments, no repayments. At the same time, cost continued, for example, for staff. So what was important to make sure that they had the buffers, the liquidity buffers, to get through this period of lockdowns, of economic inactivity, basically. So we mapped, well, the risks. We did see where we could support our investees, so by providing additional liquidity, for example, but also loans that matured in this lockdown period, see where we could renew those. But if we were the only one to do that and other investors would withdraw their money, then still microfinance institution would go bankrupt. So we realized that we need each other. So we did reach out to all actors in the sector. And I think there, jointly it came to a common understanding and mutual agreements that we're all willing to provide this trust to the sector and all provide this liquidity to get through this period. And this is also what we did see in the end. So as soon as lockdowns were lifted, economic activity started again. So it is about the farmer who could go to the market again with the milk. So we're not talking about luxury products, but about local needs. And as soon as that happened, payments to the financial institutions restarted again, and recovery in the sector restarted. Yeah.
Great, thanks for that explanation. And I wanted to hear also from Jan how he looked at were there, for example, differences between the different geographies that you're covering, and also you launched a sort of different type of product to reach out to your investors and find a type of support to probably support that liquidity. Can you talk a little bit about that as well?
Yeah, sure. So I think we really agree with this assessment that liquidity was really important especially during these lockdown periods, and really there to be able to support institutions, because interestingly, many of them still continued also to finance, right? While I think financial markets were sort of really liquidity is king, and we have to observe this. In the case of microfinance, really what we've seen is that some of them really continued, also to finance even in that period. So really liquidity there was important to support institutions, continue, and really also help in contexts where moratoria were given to people that were just not be able to pay the microfinance loans. And so that was really important to step in there. And what we've also seen is that institutions really have adapted their operational systems. So we see a huge push towards digitalization. That's I found really interesting. And you can see that really in Africa, but also in Latin America, Asia, and other regions we work in. It's really the strong push towards digital, where institutions have understood that. I mean, that's really the way how to continue working in that environment. And especially in the beginning when people didn't know how long this will still take. So really something we've observed there, which I found really also interesting, and again shows to say how really institutions and micro borrowers have adapted to these situations. And really for me, key takeaway really is to see how really the capacity of adaptation is there in many cases, and how overall the sector has been, I think, more resilient than maybe we would have expected a year ago, when we now look back. So I think that's also, interesting. And what we have done then on Blue Orchard, and that's really then also in line with our experience in the different regions, we have for sure have seen different impacts, right? If you compare certain countries, Latin America, Asia, or again Africa, and it really has to do also with government action. So what really, and Tim mentioned this, this is really important. On these lockdowns, how severe were they? How long were they? How prolonged were they? How deep were they really going into the economy? And depending on that, the impact overall was also very differently felt locally. So we have certain countries where this has been really strong and really has been leading to a lot of consequences for daily life, and other countries where these periods have been much shorter, and then sometimes also consequences for daily life were not as dramatic as it has been. Although still, of course, there were global impacts that had been felt. So, but we really observed this, and when this pandemic started, we also saw this need for liquidity in the short term, but we also saw that maybe over the medium term, given that some of the institutions, some of the micro borrowers will be restructured, will be having their debt extended longer in the future. Some may actually run into really payment issues. So really anticipating also deteriorations of portfolio qualities. Maybe that's when we really started to think about, what kind of strategy can we develop around these themes of liquidity support in the short term and sort of more solvency support in the longer term. And that's where then we developed that specific strategy to address this. And overall, I can say that the reaction in the markets were extremely positive, right? So also in terms of timing, but also in terms of amounts overall, right? So we achieved first closing still in 2020, so still really when the pandemic was ongoing, first closing with over 150 million in committed funds, which was then really shortly followed with the second closing we then achieved in 2021 already with 60 million. So overall, really over 200 million in terms of commitments and really the possible disbursements doing in that area, no? And really in a short period of time, no? And those of us who know, sometimes these processes can really take time. So in this case, really, I think there was this action, there was this need of urgency, and really then a big push forward in that direction, no? And of making these funds available to really support institutions in their liquidity, continue growing, and especially when really the activity started to expand again. And also that's also again something that Tim mentioned was really important, to then be able to actually provide funding for growth, right? And to be able to really there, when micro entrepreneurs go again, do their business, you know, agriculture, selling, whatever, small commercial trade, really to then expand again and to have the liquidity there. That I think was really key. And that's where strategies as this one really have, I think, played a super important role last year. You know?
Great. I do have a Q&A here, a question actually by Sandarayan. I hope I pronounced that correctly. It says, what about the disbursement by organization during the COVID-19? I feel like maybe this question has been addressed, but if you want to add something, you're welcome to. Otherwise, I'll ask the participant to specify the question.
I mean, from the Orchard experience, I can definitely say that with this strategy specifically, but also for our strategies, other strategies, really be able to continue supporting the sector, including 2020, and of course after that as well. No, so I think there were, of course, there had to be views on risks, right? Depending on the countries where we were, depending on the institutions, how strong they were when they went into a sort of pandemic crisis. And there were these considerations, right? So there has to be an approach which sometimes is then more conservative, but overall, I think we really much continue to work with the sector, you know, be it in 2020 or then continuation in early 21.
Thank you. Now, COVID is a little bit like a special theme, obviously, not something that you would plan for. But there are other themes that microfinance often focuses on. And one question for you, Cecilia, is how important are the impact themes for you at Nordea Life and Pension? Given an equivalent risk-return profile, would you favor COVID relief over another impact-oriented theme, like education, for example, or climate? Does that have a higher priority? How do you organize these focus areas, I would say? If you had a choice, how would you decide?
Yes, I mean, impact thematic investments is something that we have increased quite significantly throughout the last few years. And it's something that we have also decided to focus on, where, I mean, there are tons of themes that we can invest in when it comes to within the sustainable investment approach, and we can't really we need to focus on a few, as you mentioned. We have prioritized them, and as you mentioned, climate is the theme that we have prioritized the most. Doesn't rule out other themes, but climate is what we have decided in the near term to be the most important area where we would focus a lot on. We've also highlighted human rights and education as other prioritized areas. But how we choose, how we prioritize, I would say in general, it's we have to see what's the sense of urgency. Of course, I mean, all these themes are important and urgent. Poverty is something that we really need to solve, but we have prioritized climate as the most important theme currently, because it's a great sense of urgency. It's also where we believe we can make the most impact because it covers all our investments. So wherever we invest, we have to add the theme climate. So not only for impact investments, but for all other investments, climate is something that is prioritized. But we can also look at smaller themes like education. It's a big task to solve, but it's also more niched when it comes to investments. So we do have themes that we have highlighted, and we do prioritize them. So that means that we make larger investments when it comes to climate, but we do make other impact investments, and we also have investment that has like 5 themes. So yes, and that is something that is important, and I think that we will do, or I know we will do much more in the next few years for this.
Excellent. So perhaps Jan, you want to give us some example of the type of investments you can make through microfinance that generates positive impact in education or climate change, for example?
Yeah, sure. And then specifically on the education theme, as Cecilia mentioned, right, for us, this is one of the strategies we have actually a focus on, specifically in Africa, right, where we try to finance education through with our partners on the ground, right? And there it's again it's a huge challenge. I mean, you mentioned climate change, but also education is still, and specifically Africa, a huge challenge. If you think about that, you have still out of school rates that are very high in many countries there. If you talk about primary education, but even more so in secondary education, you would see 37% of lower secondary age out of school rate, and going up to 58%, for secondary upper secondary age. So and really these are the highest, I think, ratios that you would find anywhere in the world, and this results then in this number we've also been hearing a lot recently, is this over 110 million really children being out of school in Africa, right? So really huge challenge. And which also has to do with the fact that on local, let's say, state or government level, the funds that are mobilized are just not sufficient now to really bring more people in at school and to school, and especially in school with good level of quality. I think that's where the strategy we have developed, it really makes a lot of sense, because it tries to finance through, again, microfinance, so through these institutions we work with. It tries to finance schools, so and again also individual borrowers, right? And so far, really, the fund has financed over 100,000, or is currently financing over 100,000 students, over 1,500 schools, but in different countries in the continent. And it's again where we, I think, see that microfinance as a vehicle, and also this approach of blended finance, right, of really trying to structure public-private sort of strategies, really can play a super important role, again, in parallel with government efforts. So it's not, I think, seen as a competition, right, to what government does, but really in addition to what the governments do in the different countries. It really plays a very important role. And specifically, if you think about professional education, and that's something which in the context of this strategy we've been talking about a lot, is really this sort of phenomena you see of professional education being a little bit undervalued now in many countries. And so if you think about, mechanics, if you think about plumbers, if you think about this type of really important professions, they tend to be a bit undervaluated, and the whole, let's say, education around these professions as well, no? So there, to have more focus in supporting financing institutions that provide this kind of education, really for us made really a lot of sense. And it's where I think, again, such a microfinance vehicle as the one we work on as Blue Orchard, we work on there, as really made a lot of sense, and continues to be making a lot of sense in my view.
And this theme must be quite close to your heart, since you were a teacher yourself, I believe.
Yeah, I mean, I was teaching, to people from the financial system, a bit in Africa, but also in Latin America, in Germany. And I think, when we really entered into teams like accounting, financial mathematics, and so forth, you get a sense of the needs of secondary education in these aspects, right? And I think you really understand that financing and push in this direction is really important, not only for this concrete education, but also for follow-on educations, right, that people may do, or professional educations that people do. You need this basis now to be able to develop on that. Yeah. So again, it's a theme which is very close to us. It's very important for us as a strategy. And I think it's also been one of those where we really been able to show with success that microfinance, again, as a tool here, can sort of connect investors to really and borrowers to schools, to really people that want to finance their education.
Sounds great. And then maybe on the climate change side, Tim, do you have an example there on the type of investments that you can make through microfinance, and give a little bit of color to our audience on what it means concretely you invest in when you're helping out with climate change in these emerging economies?
Yeah, sure. And I think before diving into an example, some reflections there, because we indeed sometimes as a financial specialist, we like to think in buckets. Sometimes I hear okay, should we go for the one SDG, more the clean energy, or the other one, which is maybe more towards social inclusion. I think in Triodos, and that's ingrained in our philosophy as well, it is all integrated. So environment and society there. In the end, the climate transition is also a social issue. So in a way, yeah, in the end, if populations will suffer, it will mostly be in the emerging markets where people will be hit hardest. And that's also what we try to address there. So Triodos has been active in the renewable energy field. Well, in 1986, it was the first financier actually of the first windmill in the Netherlands. And that's something we continued, and also in emerging markets. So on that side, we did launch just now actually a fund focused on renewable energy in emerging markets. So that's really actually tapping onto the idea, like, why are we not putting solar panels in the tropical areas? Well, that's what it does here. So that's the Triodos Emerging Markets Renewable Energy Fund that we launched. At the same time, we need to make sure that the people in these countries, have the resilience and the buffers to withstand every crisis situation or climate or tropical situation that could come there. And I think that's the crucial element of microfinance. So providing people the buffers to weather any crisis periods. Also, for example, savings. And the importance of savings accounts was became clear in pandemic times. So that's a nice one where there was a survey among microfinance clients globally, and 50% of them said, well, we actually had to use our savings accounts. Well, let alone they had savings accounts. So that's also, we're not only talking about microcredit, but about microfinance. So I think in a way, microfinance helps in general to make people resilient and to have buffers to actually deal with the consequences of climate change. Specifically, of course, what you see is that there are more and more models, credit solutions aimed at targeting, for example, clean energy. So since a couple of years, we see, especially in East Africa, but now also globally, as they call it, the providers of solar home systems. So these are solar panels, charger, battery for the people who are not connected to the electricity grid. So for example, India or Africa, a large part of the population is not connected to the electricity grid. And we have an example, Mkopa in Kenya. They actually, people can buy credit to purchase such an solar home system, and then repay it in installments. And that's actually a great example of how to connect people to energy, but then clean energy in a way. Another example is in Acceso Creditio, that's in Peru. It's focused on clean transport. So yeah, I think we all have the images of smog cities sometimes. And what Acceso Creditio does is they provide loans to taxi drivers actually to transform their gas-driven, fuel-driven taxis into LNG-driven taxis, which is still a step in the transition, but still an important step. Well, if you look at the local context in Peru, I think a lot of more steps need to be made there. But you see business models emerging to address specific impact needs. And this is the clean energy. Indeed, on education, as Jan mentioned, also there, you have this integrated approach. In a way, I think microfinance, part of the entire model is to provide financial literacy training to everyone, all end clients as well. So that's also already, I think, ingrained in the principles that we as a sector have from a sort of responsible consumer protection principle, that, well, the people that you provide a loan that actually never had any financial training before, that you actually make sure that they actually get the training to understand what it is to have a loan and what it means to repay, well, to pay the interest, but also to repay the loan in installments. So that's all already financial literacy. So financial education is already ingrained in the microfinance model itself. And indeed, there are more and more specific models coming up to specifically address education. I think a very nice example is Shiksha in India. We work with them. And Vartanis India is a similar one. They provide loans to private rural schools in India. And here private is not for the rich, but it is actually in areas where there's a lack of public schools, and local people, for example, former teachers, they start homeschooling people. I've been to a village there, and there was also now a female director of a school, 600 people, and she said, 15 years ago, I started homeschooling my kids. Neighbors come, they ask me, can you teach our children as well, educate our children? And now she has this school of 600 people. And Shiksha Finance in India, they provide the loans directly to these schools to expand their building or to acquire, purchase education materials. And that's a very nice example of a credit solution for a specific impact need locally.
Great examples. Thank you, Tim. And you alluded to the fact that you are, teaching financial literacy. That's probably part of this financial inclusion team, which is this overarching team in a way that microfinance tries to address this with the ultimate goal of addressing poverty in many areas. And now this has opened a whole new team with Fintech, I believe. So Tim, can you tell us what is happening with Fintech and what influence the spread of internet access and technology has on financial inclusion? How does it translate into investment opportunities more specifically?
Yeah, I think what is important is also to break down the container term Fintech. So Fintech referring to financial technology. I think we started looking into this 2013, 2014. And the first question was what it actually means and what can it add to all the objectives of financial inclusion. I think there's a clear, we quickly came to the realization there's a clear benefit. So not so much tech for the sake of technology, but people in, for example, remote areas where it's very costly to set up a bank branch. It's easier for microfinance institutions to provide loans, well, through technology. Also mobile payments. So in especially East Africa or India, quickly mobile payment systems popped up. And that has a security element as well for a lot of people. So no need to walk with cash in your pocket to a bank branch to actually repay your loan, for example. But you can do that all through your mobile phone. And this is not all like smartphone, but it can be even SMS systems or something like these. So there's a clear benefit also from our social objective perspective. But then still, what does it mean, Fintech? So we did break it down and we started, well, there's online lending that's close to what we know. So we know cash-based lending, well, online lending is something new, but it's something that we are able to assess. Well, what's next to that? That's lending in a slightly different way, but much more the crowdfunding platforms, for example. That's not so much one microfinance institution that provides a loan, but having this platform. And those are models that we think indeed have a clear benefit there. What we did also do back then is invest in some global fintech funds with a social mission as well. And that gave us access to actually a wider portfolio of fintechs, socially focused fintechs, and to see what the risks were and how they would deal also with, well, social issues, for example. I think that, and we did quite some investments there. I think if you look at the Triodos Microfinance fund portfolio now, like 7% you could qualify as fintech. Well, we want to increase that. Maybe it looks small. At the same time, you should realize that the amounts are most of the time smaller than if you would invest in a bigger SME bank, for example, because these are startups that we talk about. And that's one element. I think for us, the next step would be to look at, for example, payment systems, which are equally important, especially if you talk about remittances. So the diaspora that actually sends money back to their home country. Well, that's one element of the technology. The other one is the digitization of the microfinance institutions themselves. So it's not an either or, like there are new models taking over the traditional microfinance institutions. I think the same happened actually in closer to home in the Western market, where the promise of new players was high, but you also did see quickly the mainstream banks digitizing, taking over fintechs and actually offering tech solutions themselves. And that's equally important to make sure that the microfinance institutions that we finance, that they are also digitizing there. And both on the digitization of microfinance institutions, as well as the new fintechs, what's key for us is to look at what we call the tech and touch approach. So you should still be able, although you use a lot of technology to be more efficient, to be safer, you still need to understand your customer and not just have an online application, just send the money based on an algorithm and that's it. No, you still need to understand the customer and visit that customer. So an example is a fintech in Peru that we financed. It's Bien para Bien, it's called. Well, they have an online application process, and which is sent to the head office. They make a first credit assessment, but then still a loan officer goes to the business, to the entrepreneur, to actually see the person and see if it's really doing what they're saying that they're doing. But then thereafter, you can still transfer the money through mobile payment systems. And that can also be done on a tech element. So that's really crucial for us to also make sure also that it's a responsible solution, but then the benefits are really there. And I think the importance has even increased or underlined in COVID times, where microfinance institutions were able to continue payments, when there was a mobile tech solution. Microfinance institutions that solely relied on cash had to close their bank branches. People could not bring their cash to the branch. So then, the importance for example, more mobile money only increased there. Another example is an investment that we did in Coinworks in Indonesia, which is a crowdfunding platform. And in Indonesia, with all the islands, very complicated actually to set up branches on all the islands and have that cash-based. Well, this is a crowdfunding platform. Coinworks themselves, they invest in entrepreneurs and businesses, but they put the transaction on their platform, and then local high net worth individuals they can invest as well, and that's actually quite successful. Yeah.
Great.
So the future
I think
we
want to leave some time also to hear from Jan's perspective and see a little bit how he sees microfinance in his different focus regions. Do you have a couple of examples before we turn to Cecilia and look at her perspective as a pension investor?
Yeah, sure. I mean, and also maybe on the fintech part. I mean, if you allow, right, just to provide an example here, we were recently traveling to South Africa with the team, and we were looking at at how people were really doing these cross-border payments. That's how, remittances, really, what is it about? Cross-border payments, sending from one country to the other. And how this is done is still really, there is a central stop in the city. There are buses going from, let's say, South Africa to Mozambique. This is a country in the north. And so people would give money to the bus driver. The bus driver takes the envelope with the money, drives cross-border, drives to where the destination is, and gives the envelope to the people that needs to receive it on the other hand, right? So a physical way of transferring funds, right? And that's really happening, no? And for that service, the bus driver really charges also a hefty fee, no? Because he has to manage the cash, there's risks involved, and so forth, right? And it's really what you can still see. You can see that in South Africa with cross-border payments. You could also see it in Kenya at some point, before there some innovations came in and really replaced this. And so really there the need to I think develop solutions that will help people transfer funds from one country to the other, or even within the same country from the capital city to more remote places, is that where we really see there's huge impact potential, right? In terms of financial inclusion, you mentioned this before, so really giving access to people to this kind of services, which otherwise it's very difficult to have access to, or because it becomes much cheaper, no? Because evidently people doing things over a mobile wallet, mobile phone applications, that can make things much cheaper than the bus driver would charge to transfer this money there, no? And really here, I think these are just very practical examples where you see that with innovations like this, which are really happening, and these are things we look at, and really in Blue Orchard we've been in looking at investments in this area, is really because you see immediately it's a sort of a strong impact here in terms of really improving quality of life for people, through this. It's I think just really important, and in terms of really geographies, I mean, that's a tendency we see really in many places, right? So they are sort of really, and that's, I think in Africa, we really see that a lot, is really sort of technology hubs that are developing, around cities like Nairobi, around cities like Lagos, also around in Morocco, in several places, or in South Africa, in Cape Town, where you really see these tech hubs sort of really being interesting for talent, for IT related talent. There are startups being built up, some extremely successful, then really working together with telephone companies. This in Kenya is a very famous example is this M-Pesa technology, right? Which is a company that is working with a large telephone provider, but which essentially what it does is helping people transfer money, And it became so successful. Why? Because in Nairobi, there were a lot of security issues around the elections. People needed to send money outside, but couldn't really travel. Suddenly, a tool like this becomes used. So really this sort of technology development, these hubs, we see that developing really in specifically in Africa. I found it fascinating. So that you have this sort of backlog in terms of really heavy infrastructure, but in parallel, you see this amazing innovations on the technology side, right? And in places like Nairobi, Lagos, or Cape Town. So I think that's really something noteworthy, and I think where again microfinance can play a really important role in just supporting and investing in these industries, which, by the way, from a commercial perspective, are also extremely attractive, right? Because they're really are sound and sustainable business models that are being built up there. So also good investments from a not only from impact perspective, but really also from a commercial perspective.
Great. Before I take a question, or I should say a series of questions from the Q&A, I wanted to hear from Cecilia on her perspective on microfinance and fintech, but also fintech a little bit broader in the impact allocation that you have. And more specifically, how do you look at fintech in relation to climate change targets? Because perhaps there could be a conflict of interest there, so to say.
Yes, I mean, if I just go firstly to the climate question, and that is, it's very easy when you talk to companies or you discuss investment that people might say, no, it's not applicable to us because our business is we're not producing anything. We're not a heavy industry. We're just IT related company or fintech, etc. But we have, for us, I mean, it's a growing problem and a growing concern, as we all know, that the tech companies are requiring a lot of server capacity, and the servers are emitting a lot of CO2. So that is something that we always want the companies that we invest in to put requirements on their suppliers and to look on the whole chain and to basically see what solutions are there that we can do this better. There are also companies that we are investing in that are working to solve this issue with cooling down of servers in a more environmentally friendly way, doing it in regions that is better than others, where, for example, Sweden is a good area because we have green electricity, which can be used rather than placing the servers in a country where you have coal as the main source of electricity. So that is something that we take into account, say as we discuss with other types of companies. So it is a growing concern that needs to be solved. I would say absolutely. And your other question in terms of if we look at fintechs and impact in other areas, and we do, and it relates a lot to what actually Jan talked about. We do invest in venture. That's where I would say in our portfolio, that's where we find the most fintech related companies that are with a great impact, and that is actually very fintech/tech impact companies. And given the fintech, it's growing, it's rapid growth, it's global, it can target small customers. We have invested in some companies that are focusing on emerging markets to help solve the issues of transfer of cash, payment solutions. And in the exactly what Jan mentioned is that in regions where the people are not so wealthy and the infrastructure is quite weak, then fintech can actually enable them to be able to trade, to pay for goods, to start companies, to use the whole capital structure basically throughout the help of new technologies. And we are actually seeing, I can just confirm what he said, that we are seeing Africa as a region where we see a lot of growth in this this area. So fintech can impact, and I would say Africa stands out as the region where we will see most companies popping up. And then we also have Nordic companies that are focusing on growing in these regions as well. So a lot is happening there, and in the venture space, I would say that's where we have the most fintech impact currently.
Great, and that's a great way to follow up with our Q&A here. We have a question from Søren. He's asking a few questions, and I'm just going to ask them in a different order from what he has asked them. So the first one relating to your point, because it seems like a lot of the opportunities in fintech are in venture, and that's more on the equity side, I suppose, for you. So a question to Tim and Jan, do you supplement some of the microfinance debt in the markets you are present in with equity investments? Perhaps Tim, you want to take this one?
Yeah, that's yeah. So we indeed have we provide both private debt and private equity. So on the portfolio level, we see it as a majority private debt, and that's also what we aim for in terms of returns. So fixed income with a financial upside from the private equity allocation. In general, so let me start with the general target allocation. We do this for two reasons. One is financially. So over the years, historically, the equity side has provided an upside to the fixed income from the debt portfolio, but also for impact purposes. When we have an equity investment, we do what we call strategic minority stake, so a stake that enables us to have a board seat. So, for example, as a non-executive board member, and that helps us to be closer to the company and actually help microfinance institutions to develop and professionalize. So we have quite some investments that equity investments that we started with in the 2000s already, and by now have grown to bigger commercial microfinance institutions in the country. And here we leverage on being part of a Triodos Bank group. So, for example, we have the head of credit risk from Triodos Bank. He went to one of our equity investments in Tunisia to actually help shape them, their credit risk policies, etc. So that's the added value there. Specifically to fintech, this is where we do the same. We have the same approach, so we can provide both debt as well as equity. Of course, it comes with a different risk assessment, so we need to be sure that we follow the same strategy as we normally have. So that means we come in with private debt to test the waters, and then with the better performing ones, the more promising investments, we can also move to become a shareholder there. This is what we did recently for the first time with a fintech investment there, and then also actually bring in our expertise that we have more closer to the company. So that's indeed the way how we do it. So that can also plays a clear role in fintech. Last side remark for Cecilia, I know the buckets that we are placing in, and that's another reason why we keep the equity allocation limited. So we are complying with the Solvency II requirements there. That's a detail.
That's an interesting constraint. The other part of the question here, perhaps for you, Jan, because I think that sort of has a good summary of how you manage your fund at Triodos. But another part of the question from Søren is, what makes your fund and strategy unique? So perhaps, Jan, you want to add something there for your strategy?
Yeah, again, and also maybe to add on the private equity part that Tim was just mentioning. I think really what we've been trying to do here, really, but using this private equity as really a tool for innovation and really getting to implement new things, so that maybe don't exist in certain markets. And I think that's where really strategies can make huge difference. And in the case in Blue Orchard, what we've done is really trying to work with a private equity strategy on climate change. Again, there we've discussed this before, right? Where we are trying to work with companies that can contribute to implement insurances that are climate-related insurances. So these are insurances against climate risks. So I think we know the climate risks. I mean, the risks for flooding or others, and really regional. This can be really significant if you think about El Niño phenomena also in Latin America, right? So these are really important phenomena that affect businesses, and they're an innovation that already exists in more advanced markets, but not yet in emerging markets that much, is really this climate insurances, so that people can have access to really basic insurance model that would help them, where if there is a climate event, to recover actually losses from this climate event. And so there are different models, but one that we found really particularly interesting is this parametric insurance model, where essentially it's more or less an automatic calculation that will then work and will help people to quickly recover from these losses. So really, then as an investor coming in a company here and really pushing these sorts of innovations, I think that's when you really can make a difference, also from let's say private equity point of view, right? Because then, as Tim mentioned, we would then also as investors get involved with these companies, possibly be present in some part of the governance there, and really trying to push innovation through this channel. So I think again, private equity there can be a very important tool, to make, as you said, right, to really make a difference in certain markets.
Fantastic. We are running out of time, surprisingly, and there is still a part of the question of Søren that is unanswered, but I think we will follow up with this information by email, because he's asking about your historical risk and return. So I guess that's better answered in writing. But just to give you a last word, I would just want to ask you for a forward-looking reflection. So maybe just a couple of sentences each. Beyond fintech, what do you think can be the next game changer in microfinance? And what can drive more capital in microfinance going forward? Jan, since you were the last to speak.
Also, again, I think, yeah, it's a big question. No, I think there's really many aspects we've touched base now, which I think really could see major developments. For me, it's again, one big aspect is technology, right? So where we can see that just institutions becoming more efficient, being able to again also drive down on interest rates and developing that to be commercial strategies. I think that's really very important aspects. And another development we really see is also the institutions themselves really also consolidating and becoming themselves more and more sort of, how to say, develop financial structures. No? So if you think many microfinance institutions started as NGO type of organizations, a bit informal, really strong role of founders and so forth. And you see these institutions developing, consolidating, becoming sometimes larger, and really key, I think, for impact investments such as us in the Blue Orchard, really be able to continue work with these institutions also as they grow, right? And so I think there again, also being able to mobilize capital to not only provide really small amounts, but as these institutions grow, as they consolidate, as also their clients grow, as micro borrowers start to not be micro anymore, but start to be SME, right? To then really be able and continue finance. I think for me, that's one of the key elements as we go forward alongside to developments in technology.
Great. So Cecilia, for you, what could make it even easier for you to allocate more capital to microfinance?
I mean, I think that the thematic approach could help. So if that is being more themes highlighted, more a clearer sort of it's more about, I think, information sharing, but to sort of educate investors like me on the themes that are investable, and also the impact that is making. So not only that it's financial inclusion and that in terms of the general microfinance characteristics, but more to add another dimension, which will be then more focus on themes together with the original microfinance strategy.
Great. And Tim, you have the last word here. What's going to be your game changer in the industry? Anything else?
Yeah, it actually relates to Cecilia's point, because I think what we see, and it's driven by technology, but is what we call embedded finance. So much more specific credit solutions, microfinance solution targeting one SDG, or basically that's how we call it, but it grows locally, it's rooted locally, a specific solution there. So I did mention the solar home systems, or for example, the conversion of taxis, or on education specifically for schools. So specific credit solutions addressing a specific theme, or solar irrigation pumps, and then a business models, credit solution specifically around that. I think that's sort of embedded finance targeting one theme. That's also what we see more and more in the field. I think on the investor side, what can drive more capital into microfinance, at the one end, is increasing awareness of responsibility of investors, either driven by regulation or the public, but also internally feeling, well, maybe especially after the COVID crisis with the increased social inequalities, the internalized responsibility as an investor. And I think what helps there is also the realization that good and reasonable profits are no trade-offs. So I think until recently, there was a sort of feeling like, okay, if I invest for good, yeah, that there will be trade-off to my returns. And I think that has been shown by us and the long-lasting profitable good funds that there are, good impact funds that there are, that's no longer the case. We actually have asked in the past an independent research company to confirm that. And I think that's something, it is possible to do good, invest for good, and have a reasonable profit.
Well, that was very nice last words. Thank you so much for this discussion today. I hope that you have learned something. I certainly have. There was one question that was unanswered because it was asked a little bit on the late side, but I propose that we try and answer that offline. Other than that, the recording of today will be available on Nordsip very shortly. With a summarized writing. We're also going to publish a special magazine on impact investing. And like every year, our impact investing handbook, you will find different themes regarding impact, including this summary of this discussion today. I hope you enjoy that, and don't hesitate to reach out to us if there's anything else you wonder about and that you think we should cover. Thank you for today and have a lovely day.